If you were born before 1964, August 2026 is not just the middle of summer. It is a month with three specific financial changes already in motion that could shrink what lands in your account, shift what you owe at tax time, and alter what your spouse collects if something happens to you. Most of these updates will not come with a letter in your mailbox. The government will not call. And by the time most people find out, the window to act has either closed or cost them real money. So let's walk through this together, step by step, before that happens to you. The first change is one I've been watching for months. The second one catches couples completely off guard, especially widows and widowers. And the third one involves a dollar threshold that most retirement accounts are pushing up against right now, with a tax consequence almost nobody sees coming until it hits the deposit they were counting on. Social Security and tax rules shift every single year, and nobody from the government calls to explain what those shifts mean for your household. That is exactly what this channel is here for. If you are not subscribed, hit that button now and turn on the bell, because this is the kind of information that does not show up in the news until after the damage is done. Let us get into it. The change that affects the most people watching this right now involves the earnings thresholds tied to Social Security taxation. Here is the part that is almost never explained clearly. Social Security benefits are not simply taxed or not taxed. There is a middle band, and whether you land in it or above it depends on something called combined income, which is your adjusted gross income plus any non-taxable interest plus half of your Social Security benefit. That combined income is then compared against thresholds that have not moved in decades. The lower threshold for a married couple filing jointly has sat at $32,000 since 1983. The upper threshold is $44,000. Those numbers were set when the average Social Security benefit was a fraction of what it is today. Between annual cost of living adjustments and the growth of retirement account balances, more and more households are being pushed into the taxable zone every single year without taking a single step differently from what they did the year before. Here is what that means in real numbers. A couple where both spouses collect Social Security, one at $2,100 a month and one at $1,400 a month, already has $42,000 a year just in Social Security income. Half of that goes into the combined income calculation. So they are starting at $21,000 before they add $1 of IRA withdrawals, pension income, or interest. A modest IRA withdrawal of $15,000 puts their combined income at $36,000. They are now above the lower threshold, which means up to 50% of their benefit becomes taxable. Another $10,000 in withdrawals, and they cross $44,000, and now up to 85% of their Social Security is fair game for the IRS. What changed in August 2026 is not the thresholds themselves. Those have not moved. What changed is that the 2026 cost of living adjustment pushed the average benefit higher again, and a growing number of households just crossed one of these lines for the first time this year without realizing it. If you had a direct deposit in August that looked a little different than you expected, or if your estimated quarterly tax situation seems off, this is worth looking at carefully. And I do want to say clearly, what I walk through here is educational, and your specific numbers can look quite different from any example I give. A tax professional who works with retirees can run your actual combined income in about 20 minutes and tell you exactly where you stand. Now, let me introduce you to a man named Raymond. Raymond is 69 years old, a retired electrician from Dayton, Ohio. He and his wife Carol collected their benefits on schedule, planned conservatively, and felt good about where they were. When Raymond turned 68, his financial picture shifted slightly because Carol started drawing a spousal benefit. Their combined monthly deposit went up, which felt like a win. What Raymond did not know, and what nobody told him, is that that increase pushed their combined income past the $32,000 threshold. For the first time in their retirement, a chunk of their Social Security became taxable. They did not owe a fortune. But they owed more than they expected, and that threw off the quarterly estimates they had been making comfortably for 2 years. Raymond told me in a comment, and I read every one, that the worst part was not the bill. It was the feeling that the rules had changed under his feet without warning. That feeling is not paranoia. It is the natural result of a system where the underlying thresholds are frozen while every other number goes up. You did nothing wrong. The system just does not tell you this. But the change that is hitting couples hardest this summer, and the one that I think generates the most avoidable pain, is buried inside the rules for survivor benefits. When a spouse passes away, the surviving spouse is entitled to receive whichever benefit is larger, their own retirement benefit or the benefit their spouse was collecting. That sounds straightforward. In practice, there's a timing element that reshapes the math entirely, and it is tied to a rule that many couples discover too late. The size of a survivor benefit is locked to the amount the deceased spouse was actually collecting at the time of death, not what they might have collected at full retirement age, and not some idealized maximum. If your spouse claimed their benefit early, at 62 or 63, their monthly amount was permanently reduced, sometimes by 25 to 30% below what they would have received at full retirement age. When that spouse passes, the survivor benefit the surviving spouse can claim is based on that reduced number, not on the original full amount. Let me do the math live so it lands. Suppose your spouse's full retirement age benefit would have been $2,400 a month. They claimed at 62, and their actual benefit landed at about $1,700 a month after the early claiming reduction. When that spouse passes, and you, as the surviving spouse, are entitled to step up to their benefit, you are stepping up to $1,700 a month, not $2,400. Over a 20-year widowhood, the difference between those two numbers is more than $168,000. That is not a rounding error. That is a house payment. That is a car and a decade of groceries. What changed in August 2026 is that the Social Security Administration updated some of its internal processing timelines and survivor notification procedures, meaning the timing of when a surviving spouse can apply and what documentation is required has shifted slightly. If you or someone you know has recently lost a spouse and has not yet contacted the SSA to formally claim the survivor benefit, do not wait. The agency has a waiting period structure, and delays can sometimes mean a gap in payments. I would call the official SSA line or visit your local office directly. The specific procedures I am describing are general guidance, and your situation may have details that require a direct conversation with an SSA representative. The broader point here is one I want every couple watching this to sit with. The decision your spouse makes about when to claim is not just their decision. It follows both of you for the rest of your lives. If you are the higher earner in your household and you are weighing whether to claim early or wait, you are not just deciding for yourself, you are deciding for your spouse if you go first. This is the conversation most couples have not had, and the one I would ask you to have this week. There is a third shift landing in August 2026 that is quieter than the first two, but affects a specific group of retirees in a way that can be genuinely destabilizing. It involves required minimum distributions from traditional IRAs and similar retirement accounts, and it connects directly to the tax trap I touched on earlier. The rules around required minimum distributions have been updated several times in recent years, with changes to the starting age and calculation tables. What matters for August is this. The accounts that grew through the long bull market of the last decade are now significantly larger than the models most retirees built their plans around. A traditional IRA that was worth $200,000 8 years ago and has grown to $320,000 generates a meaningfully higher required minimum distribution than the original projections anticipated, and that higher distribution goes directly into adjusted gross income. Think back to Raymond and Carol for a moment. Imagine they also had an IRA with a required minimum distribution of $18,000 this year, instead of the $12,000 they planned for 6 years ago when they first sat down and mapped out their retirement income. That additional $6,000 could push their combined income above the upper Social Security taxation threshold, triggering an increase in the taxable portion of their benefits. The IRA growth that felt like good news becomes a tax lever that the system pulls automatically with no vote required. Here is the layer that makes this worse. In August specifically, many retirees take their required minimum distributions in the second half of the year, and some wait until December. If you are going to hit a threshold that changes your tax exposure, the earlier you know about it, the more options you have. You might choose to spread the distribution over the year. You might look at whether a qualified charitable distribution makes sense, which allows you to send the required amount directly to a qualifying charity and have it satisfy the requirement without going into your taxable income. That option is available to individuals who are 70 and a half or older, and it can be a meaningful tool for people who are charitably inclined and need to manage their tax picture at the same time. I want to be clear that qualified charitable distributions and the specific mechanics of how they interact with your overall return are not something to navigate alone if you have not done it before. This is exactly the kind of situation where spending an hour with a tax professional who specializes in retirement accounts pays for itself multiple times over. I am describing the mechanism so you know it exists and can ask the right questions. There is something bigger underneath all three of these changes, and I want to name it directly before we close. You worked for decades. You paid into this system. You made decisions based on the best information you had at the time, and now you are in a phase of life where the decisions are harder to reverse, the stakes are higher, and the system is just as complex and just as quiet about its own rules as it has always been. The thresholds that determine how much of your benefit gets taxed were set before some of your grandchildren were born. The rules that shape what your spouse inherits from your claiming decision are buried in documentation that nobody hands you at the Social Security office. The RMD calculation tables update, the account balances shift, and the tax exposure moves with them. And none of that comes with a notification. A woman named Patricia, 72 years old, a retired teacher from outside Columbus, sent a comment on one of my earlier videos. She said she had been watching for 3 months, and that in those 3 months she learned more about how her own retirement income actually works than in the previous 8 years of actually being retired. I am not saying that to compliment myself. I am saying it because Patricia's experience is common, and the fact that it is common is a problem worth naming. The information I walk through on this channel is educational and general. Your household has its own numbers, its own history, and its own combination of benefits and accounts and timing decisions that a video cannot fully account for. For anything that touches your actual tax return or your specific benefit elections, please sit down with a qualified professional who knows this territory. What a video can do, and what I try to do every time, is make sure you walk in knowing the right questions to ask and understanding the mechanism well enough that nobody can fast talk you or leave something important on the table. So here is where I want to leave you today. 3 things to do before the end of August. First, look at your most recent tax return and find your combined income number. Compare it to $32,000 if you are married filing jointly, or $25,000 if you are single. If you are above either threshold or close to it, you need to understand exactly how much of your Social Security is currently taxable and whether that number is about to change based on this year's cost of living adjustment. Second, if you are in a 2-income household and your spouse claimed before full retirement age, sit down together and talk about the survivor benefit picture. What would each of you collect if the other passed first? The Social Security Administration can give you an estimate. It is worth asking for. That conversation is not morbid. It is one of the most practical things a married couple can do. Third, check your required minimum distribution for this year and compare it against what you took last year. If your account grew significantly, the distribution went up with it. Know where that puts your combined income before December, not after. What I would ask you to do right now is drop one word in the comments for me. Just tell me which of these 3 is the one you are most focused on right now. Taxes, survivor benefits, or required minimum distributions. One word. I read every single comment. And knowing what is weighing on you most helps me plan what to walk through next. If you have a friend or a sibling or a neighbor who is in their 60s or early 70s and navigating any of these questions, please share this video with them. Not everybody searches for this kind of content. Sometimes the most helpful thing that happens to a person is that someone they trust sends them a link. The rules do not stand still. Every year, there are shifts, some small and some significant, and the people who know about them in advance are the ones who get to act on them. That is the only reason this channel exists. And I will be right here, same as always, making sure you have what you need before it costs you.